Here at Longin's Capital, we've spent over a decade building a strong track record with our full suite of services and high performing funds. Now we're setting our sights on something even bigger, an IPO in November 2027. It's been a long time coming, and we are ready for the journey. Join us in our next big step. Visit our website to learn more. Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundqueen, founding CEO at Lundqueen's Capital.
This is Sound Economies with Mel and Peter, a weekly East meets West podcast by Longines Investor Insights. Join us as we dissect the biggest and most interesting news on economies, financial markets, and central banks globally. Welcome to the show. Hi, Peter. Let's kick off the holidays with another podcast episode. How are you doing?
Well, I'm doing good, and the sort of head of the holiday season business is continuing, and we try to do everything we can to get everything done before the holiday season. But yeah, so we're doing good, and we're happy. How are you doing?
Peter, we just released last Friday our latest edition of the China and ASEAN Quarterly magazine. So we put on in focus there the services sector in the region. So that's one of the readings that we have lined up for people looking to wind down over the holidays with some content still to learn more about how the economies are doing. So another episode, another issue, magazine issue coming very soon. So that's what we're
Yeah.
being keeping us busy for our last work week of 2025. So actually, let's welcome our listeners to our last episode for the year. Of course, we'll come back sooner than later in 2026. For today, we have several topics, of course, always interesting. First, we'll start with a look at domestic chip makers in China with very high performing IPOs in the past few weeks. Then we'll look at the latest, although delayed, jobs data for the United States. Then we also look at the performance of US and China stocks for the year. Where are they
Mhm.
now? And then we look to Germany with the government setting up an investment fund, hoping to crowd in private investments. And of course, we do our global outlook, perhaps a preview of what we expect in 2026. Let me start, Peter, with China. So, several domestic chip makers are making it big as they debut in the local stock market. Very notable, just a few days ago, a company called Meta X, listed on the Shanghai Index. Um, their share price went up eightfold, so about 690% up just
Yeah.
after their IPO. And that follows a similarly successful, highly successful IPO by another company called Moore Threads, up fivefold from their IPO price. So both companies are into making graphics cards or graphic processing units for mainly used for AI developers and as well as for gamers. So very interesting. That's a new trend now as far as the China markets are concerned. They're hoping to do two things. Of course, they want to ride the AI wave and specifically be the local equivalent of NVIDIA. So the highly successful story
Yeah.
from the US. And it's also a way to go around or make up for the ban for the most developed NVIDIA chips, which are currently
Mhm.
not allowed for export to China. And
Yeah.
second, it's also to follow through the Chinese government policy to fully source and develop AI hardware within the mainland, just to be
Mhm.
self sufficient and really up their game in the AI space. So both IPOs were 2,000 times oversubscribed. So it's really a very exciting space as far as investments go. And
Yeah.
there are a few more this has inspired a few more IPOs of the similar chip line in the coming weeks. And I think this
Mhm.
is really giving China stocks a second wind of sorts, especially for
Yeah.
tech stocks. So China stocks were down a few days ago, but now given this development, there's been another
Mm,
rally and it's been
mm,
quite strong, like up 3% day to day. So, as far as the Chinese market is concerned, it's really no concern for a bubble right now, as some others are saying. And the success of these China chip makers could actually bring global prices down as far as that input, AI input is concerned. Not
mm,
necessarily as far as supply, because yeah, as we said, Nvidia, the most high-end Nvidia chips aren't available in China. So it's more of
mm.
a competition that could bring these prices down. And of course, it would support an even faster development and innovation in the AI space.
Yeah, this is fascinating in a lot of ways, seen from a lot of angles. There's no doubt if we take the overall picture and saying it sort of underlines that there are also two superpowers when it comes into chip making, and that is US and China.
Of
We see it
course.
all the times, regardless all of where we are looking, and again, Europe is losing out. Yeah, um, and also very obvious that investors they bet that there will be enormous demand domestically in China for these kind of chips, and the also the production will be serviced domestically. So, but these extreme rises just after the IPO, normally, it is often seen that that a stock that is IPO'd goes up after the first trading day, and this is what we call an IPO pop.
Mm-hmm.
But I would say this kind of sixfold and eightfold rises, if that is an IPO pop, it's more sort of a, I don't know, explosion. But and it's good to see this is typical Chinese investors. They're really alive and kicking. We that's
Yes, yes.
it is this is Chinese stock market. Um, and again, we see it, a lot of private investors in the Chinese stock market, they're dominating, and they simply jump on the wagon if they think there's something to go for. And that's also why we see things are more volatile in Chinese stock market very often. So a lot of sort of interesting stories to spin off on these IPOs, but no doubt that it is still in focus. And if we look into next year, that will simply be a sector, AI in different ways, but also the chip production. That will be a theme next year many times. I'm convinced. Yeah. So, but congratulations with some very successful IPOs in Asia.
It's very
So,
concentrated, Peter, but yeah, either it's
yeah,
very successful and very vibrant, or it's something like the Philippines where it's crickets.
yeah. It's a bit slightly more quiet, but anyway, it will come. Good. Yeah, fascinating,
Let's
Mel.
look to the US, Peter. We've long been waiting for the jobs data, very critical piece of information, which ideally would have been on the table of the Fed members last week. But
Yeah,
due to the government shutdown, they only got it a few days later.
yeah, exactly. Yeah, and then we finally got the November labor market data for 2 days ago. Of course, it is already 48 hours old, so it's not a new. We, of course, take the data sort of and rank it pretty high
Mm-hmm.
as the unemployment rose to 4.6% in November, and that is actually the highest for more than 4 years. So
Yes.
for us, it's yeah, very unfortunately just another confirmation of what we've been talking about for a whole year now, that the Trump policy, if there is a policy or a plan, economic plan, that is simply destruction of, um, uh, we would call it sort of a macroeconomic value destruction or destruction of growth or economy in the US. So that is actually just confirming this picture. We expect it to continue into the next year with the labor market getting more squeezed. Um, Middle class households and lower middle class households getting more squeezed on the economy. Also, when we look into next year, as I simply continue this pressure, also
Mhm.
on the president, we see it. So we have seen reactions the last 2 days or as of 48 hours, even from Fed members, and they are now, I almost say, um, overbetting each other about rate cuts next year. So now the market is believing in another 4 quarters rate cuts, and that is due to a slowing economy, and that is
Yes.
important. That is the important key. And of course, it will generate more volatility for the stock market because it's not a good news.
Mm-hmm.
So yeah, that was a labor market, not the best thing to carry into 2026. We're not surprised here in our company. Well,
I think, Peter, one of the more worrisome features of the job report that we read from a few days ago is that only three sectors were really hiring more people, and it's healthcare, social assistance, and construction. And of these three, healthcare and social assistance aren't really as much growth positive as the others, right? Because you just see more people needing aid from the government or more people needing care because
mm,
they're aging or they're sick. So it's not the source of vibrant growth that you want for the US. And while you see
so,
that job losses were recorded for manufacturing, for leisure, hospitality, so that's really a big red flag for the direction of the US economy. So yeah, that's what we're gonna watch out for in 2026. Ideally, it should reverse. The job market data also doesn't include the furloughed government workers. So if that was included, that would
mm,
even be worse, right? But because it's been more than a month when the government shut down, so it is really a reflection of low hire, low fire, but it's more of not a lot of businesses are expanding, postponing their plans, if any,
um,
because really they're
mhm,
very nervous right now. Yeah.
yeah, and we can see that personal consumption is under pressure, so to say,
Mhm.
and that's an engine that needs to run in the US. Well known. Yeah.
Right.
Okay, yeah. So this is as well a big theme, and we've spent some time in the new year on this one. That is natural, regardless if it goes up or down.
To bring it together, we have been mentioning a market correction coming due over the past few
Yeah.
weeks, and some are saying that this might be already the start of a correction mode. Over the last 5 days, the
Mhm.
US indices are down, um, while
Mhm.
the Chinese indices were a bit flat. But I think their directions are vastly different. So some consider a technical recession, like a technical correction rather, for China stocks, but they're up already right now. As I mentioned, there's this tech-led
Mhm.
rally again from the chip makers that have been successful in their IPOs. On the other hand, there's this ongoing jitters towards the U.S. economy. The jobs report really dampened spirits. No Santa Claus
Mhm.
rally as far as U.S. stocks. And yeah, we expect that this will continue. This could continue and could pick up in terms of the slide going into 2026. The AI hype cannot carry the rest of the index on its own back for that long. So a correction is really expected. And yeah, this might be early signs of that coming.
Yeah, it is still how we see the market. We could see more correction coming. Can be ahead of year end, or it could also be in the start of new year. But also we argue that we are sort of in the correction or very close to correction. But it's not enough. Again, we should say it's not enough to step out of the stock market in that sense. It would be crazy. We would even not even recommend to try to catch this correction. It's big enough worse to try to capture. It's too difficult.
Yes.
But again, adjust the portfolios so it's a bit more correction safe. Good. Yeah, we have a Christmas gift from the German government, and it is, as I see it, it is released slightly to the media today, actually, for a few hours ago, as we speak here. And today, Thursday, there should be a conference, rumors say, where the German government will present. It
Mhm.
is now a sort of a private equity. fund initiative. Yeah, we should even we should believe that the German Chancellor Friedrich Merz has been listening to our podcast the whole year. Maybe he has, and we'll be honored because we in the adjustment when we said okay to reduce U.S. stocks in the portfolio. Basically, it is not a year ago, but it was early 2025. We recommend to go into the non-listed market in Europe, where of course Germany plays a role. And this is now what this new German fund is aiming at, to go into to non-listed companies, invest into these companies in Germany. Of course, it's a German fund. The
Mm-hmm.
German government will come up with 30 billion euros, and they're looking out for, they're calling for another 100 billion euros from external investors. It's a bit unclear yet if the whole 130 billion uh,
Mm-hmm.
euro are sought to be only invested into private equity, as a meaning buying shares of non-listed companies, or if it also will be spent to finance companies as a lending, so to say. The fund is called Deutschland Funds, and of course we will
Okay.
follow very clearly and today what happens and the news because they're interesting. The only thing is, are we happy? Do we think it's a good idea?
Not really.
We need to say, and we are very sorry, that the government should not in any country be involved in private enterprises.
Mm-hmm.
That has never created anything good. Even if we look into our own China mutual fund, we predominantly invest into what we call private companies, as a companies that are founded by private sector people, and we try to avoid the so-called state-owned
Companies.
enterprises where the government has a majority.
Mm-hmm.
If we look into another fund that is closer to the Deutschland fund that is coming up, not in size, but at least in target, one of our two alternative investment funds, we call it the Deep Knowledge Fund, that is
Mm-hmm.
investing into particular growth companies. If they have too much equity funding or maybe even lending from government sources, particularly in Denmark, we are much more skeptical to invest into these companies. And that is simply our experience. Where we like public financing from funds is the situation where companies, they actually are doing good, but they're still too early to get really what we call bankable, so they can get serious funding in the banks. There
Right.
is sort of a sort of go-between there. And they're sort of where we say there's some public government banks in each and every country, and that is fair. They go in between there. And it's also fair when we look into very early startups that there
Mm-hmm.
are some goodies or some maybe some support in a minor scale. This is fine. We support that as well. This is where public money should be in terms of
Mm-hmm.
investing into and supporting the private startup market, growth market, private equity market. We don't see any public money being wise enough, so to say, to invest into um, private companies. This should be done by private money. We don't see the fund as so far what we've seen as the news what we've seen so far as attractive because they are looking for as it will be very big investors. But it will also there's a risk it will be used politically. And
Right.
to be very honest, now we also cover a lot about China here in our company and in our podcast. It is becoming more and more difficult to see the difference between how the German government is behaving towards the private sector and private sector companies. And if we look into how the Chinese government is doing, it is getting more and more similar. And some of the initiatives and the developments that are happening in Germany is actually
Mm-hmm.
what Europe is criticizing China for doing. It's a very interesting initiative, of course it is, because it's big money, but we don't reckon as the right initiative. The right initiative is that the government generates frames for private money to grow and
Right.
to and we see the coming economies that are interesting to invest into from a macro, sort of an overall perspective, are the economies and the countries where the private sector is getting freed up and getting better conditions. And actually, the best example in Europe right now, that is Greece. They are doing impressive work. It's a small economy, so we can't move the European economy,
Right.
but it is very good inspiration and worth to look into also for European politicians. So yeah, but today we will follow very actual the Deutschland Fund and what the German government is up to. Very exciting it is actually.
I think Germany, Peter, is trying to replicate what a lot of investment funds are doing, like ourselves. They want to
Mhm.
crowd in private capital into tech, defense, energy infrastructure,
Yeah.
but it's not really in the best place to do that, given how the public funds or public debt isn't really as well managed. So why
Yeah.
would you why would you suddenly venture into that? I think that's them trying to attract more revenues in the process. But yeah, it doesn't really look so appealing as far as private sector is concerned.
No, no, we would have preferred other initiatives to free up the German economies, but
Yes.
that will come one day, no doubt. Okay, but exciting times, and that was at least we can consider if it's a Christmas gift or not.
Yes, Peter. So actually, now that we're down to our last episode for Sound Economists this year, maybe we could zoom out a bit and consider what we're looking out for when we come back into our desks next year. Although, of course, the work will continue. We'll still be monitoring what needs to be monitored in the many moving parts of financial markets. Um,
Yeah.
we did touch upon this a bit earlier in the show. So,
Mm.
for the US, we do expect the correction to continue or to deepen as far
Mm.
as stocks are concerned. An even more squeezed consumer market. More households will be feeling the pinch from, ironically, Trump's policies that's supposed to be pro-American. So that's what
Mm.
we're expecting into 2026. And of course, that will generate a lot more volatility. That will also cause some spillover jitters to the rest of the global financial markets. And for my region, Peter, of course, Asia still growing vibrantly. Although there has been some slowdowns, especially with China struggling with its own domestic activity, it's still a lot better, faring a lot better than our European and American counterparts.
How much sunshine do we see for 2026? Yeah, as we still are in a position we see more sunshine than clouds. Talking about another bad number from US today is of course making the cloudy outlook a bit more dominant, but we still see the upside, a lot of upsides and a lot of opportunities in the world for investors, and this is actually what we focus at. Next year, we will. We've talked about it. There will be higher volatility. It will be more difficult to be an investor simply as it is.
Mm-hmm.
We would need yeah, to be more cautious, but not afraid of taking decisions. It would be more difficult to invest, and this is what we become our salary for. So and we've tried it before. We shouldn't be afraid. But this is the outlook. We basically keep the overweight of risk in a portfolio.
Mm-hmm.
So we remain in that sense positive on the world, but we will need to navigate as it looks like now. The Fed is going to cut rates even more. That will calm the fixed income markets in some sense.
Mm-hmm.
But we also need to consider, could there be a reversal at some time? Yeah, but it's not now. And we still favor, after all, we like Asian economies. We also like the government risk in Asia. It is not so that we have changed a lot in our view going into the new year. We will, though, consider, depending on if we see higher volatility, if that should lead to a change
Mm-hmm.
in how to construct the portfolio compared to how we have basically seen it the past 3 years. It is only as of the
Mm-hmm.
changes we've done in our recommendations we've done since November last year, with a couple of changes, and that has been the only one for 3 years. So there might be a few more in the coming year, but we are still happy. That is basically the message before ahead of the holiday season.
Thank you, Peter. Thank you for sharing your insights as always. And let us wish our listeners happy holidays and a sunshiny 2026.
Yes, happy holidays to everybody.
Thanks for tuning in. We'll be on the lookout for market developments worth watching. Catch the next episode of Sound Economies, Mel and Peter on the global financial markets, available on our website and on Spotify. For expert insights on the go, download the Lundin's Investor Insights app for free. Risk loving investors will find opportunities in our high quality alternative investment funds, especially our multi awarded Mutual China Fund. For more, visit lundinscapital.com.